But let's welcome on board on that note Dinanath Dubhashi from L&T Finance Holdings. Mr. Dubhashi, Q3 saw a substantial improvement for you in terms of disbursements, especially on the back of strong urban as well as rural and infrastructure demand. What is your sense? Was this demand on account of pent-up demand, or do you see a strong uptick in disbursements to actually maintain and carry forward as well?
As far as rural demand is concerned, it is, yes, some extent is pent-up demand, no doubt. But there is a confluence of good structural as well as seasonal factors in rural market. So structural factors like definitely the well-being of farmers has been good because of various measures taken by the government over the years. Like people are now having free house, subsidized house, free toilets, free gas, good interest rates, insurance, medical facilities. Because of that, what happens? Any surplus in the farmer's hands goes more for discretionary expenses, and that helps rural demand. That is the structural part. As far as the seasonal part is concerned, we have had 3 good monsoons, external reservoir levels, cropping of Kharif and realization of prices has been very good. The Rabi sowing is close to 4 to 5% above last year. Again, all seasonal factors going very, very well for rural. And if you take any rural goods, especially tractors, motorcycles, and any other goods which sell in rural, there has been very good uptick. Okay, how we expect Q4? Naturally, Q3 was a festive season, so that seasonality will always be there. But yes, generally there is a good uptick in the rural sector. We have maintained our leadership positions, number 1 in tractors, in the top 5 in two-wheelers, number 3 in microloans. We have been maintaining that, and largely we have been maintaining that based on our analytics engine, data analytics engine. We have moved away from the traditional way of doing credit in rural and do very focused, disbursements based on which dealer is performing well, which model is performing well. Data analytics throws that. I will not go into the details. And that has really helped us gain and maintain market share and leadership positions in rural. As far as infra is concerned, most definitely in our core sectors, that is road, especially the road refinance and transmission and renewables, the demand and the government push has been excellent. The loan scheme made by the government for SEBs has led to good liquidity with the state electricity boards, and thus their receivable levels have come down, just benefiting the generators. Generation level, toll levels of roads are back to or even sometimes above the pre-COVID levels, and which gives good scope for disbursements in infrastructure as well. So definitely this has been one of the factors which has tremendously helped the results this quarter.
Sure. Is this heightened demand though also accompanied by market share gains?
Okay, our market share has been more or less maintained from Q2. Our leadership positions have been more or less maintained. In places where we are leaders, obviously the market share gain will be limited, because once you are leaders, you don't keep gaining market share. And any case, we don't make a big deal out of market share. What we look at is counter share, that we choose a dealer based on our analytics where we would like to do business, and then we go for maximizing the disbursements with that dealer. Now this all converts to market share. But market share is not a metric we follow. And what happens because of this is that we do good business. At the same time, we do good quality business, which helps everywhere, which helps in NIMs, which helps in fees, which helps in credit costs. And that's why, while answering the question, I would like to make clear that market share is just a result of doing all these things right. We don't go after market share.
Mr. Dubhashi, good morning. Now, credit costs have come down by 50 basis points in the third quarter. Are you seeing room for a further reduction, and any targets that you've set for your net interest margin levels?
Okay, I think the interest cost, what do you mean? Interest cost has come down, certainly. So it has come down because of two, three things. First, we were maintaining very high, abnormally high liquid buffers in the first quarter. We reduced them slightly in quarter two. And as things have panned out well, liquidity in the system is ample. We have reduced that liquidity buffer to normal levels now. And hence the negative carry because of that liquidity buffer has substantially reduced and does helping the cost of funds. Second, of course, interest costs have been lower and a good judicious mix of commercial paper where we maintain at around 11%. And, locking into 3 years and 5 years money also at a good rate has reduced our overall cost of funds to by about 50 basis points, as you mentioned. We don't expect, it is a big reduction, and definitely we don't expect such reductions to continue in the future as we start locking into long-term rates. As far as NIMS plus fees is concerned, you will see our NIMS plus fees is at 7.3% or something. And this is a very high level. We always guide that our NIMS plus fees will vary between 6.5 to 7%. A level above 7.3% is definitely, not sustainable. That is what we believe. But at this point of time, it has helped us. It has helped us absorb some additional cost, absorb some additional credit cost, prepare our balance sheet well. It has helped us. If you ask what would be our guidance will remain same as we have been guiding always, that we will maintain it between 6.5 to 7.
Okay, fair enough. And given that L&T Finance has been showing an improvement in the collections on a month-on-month basis, how are the collections currently shaping up, and what is your outlook for 2021? Are there still any particular segments that you believe need to be monitored closely and you need to have a closer watch on?
Collections definitely have improved across segments. If you see from Q1 to Q2 to Q3, it has improved across segments. If you take rural, if you take housing, if you take infra, they have improved across segments. So that is number one. What are the fundamental factors for this? I will talk about industries first. Of course, rural, there is more cash flows, there is more improvement, no doubt. Infra, as I said, projects are on. Toll collections are good. Generator companies are getting money reasonably on time from State Electricity Board. Even in housing, real estate, good projects with low ticket sizes, good promoters, good builders, the sales have improved. Though people are not buying houses for investments anymore generally, but for own use because of various things like low interest rate, cut in stamp duty, etc. The demand for housing has done well, and hence cash flows in hands of the builders have also increased. So generally the industry, there is a positive trend, all these industries. What we have also done is using analytics, using very close monitoring based on analytics also and by our collection engine also, tried to be always better than the industry. So every segment we try to be better than the industry. Which are the segments we are still worried about? Yes, self-employed segment, SME. We have a very small LAP portfolio, about 4,000 crores. Self-employed segment, we are seeing the recovery way slower than everywhere else, as the SME sector is still not doing very well. Second segment, microfinance, even though the improvement in the industry as well as us has been fantastic. As you see, our collection efficiency is more than 98% in December. So that improvement is fantastic, but there is a little bit challenge there. Normally, when collection efficiency improves on month, every customer only improves. That somebody who has paid in September, pays in October, pays in November, etc. This time we are seeing a trend that people who pay in a month, some 3-4% of them don't pay in another month, next month, and 10% more pay. So even though month on month there is an overall improvement, the behavior of customers is still little erratic. And that's why we are maintaining such high provision coverage ratios, such high provisions, almost 1,700 crore provisions on stage 1, stage 2, to still account for these uncertainties. So if I may conclude, many sectors improving. Within that, we are trying to maintain a profile which is better than the competition. At the same time, there are sectors which are definitely not completely out of the woods, and we will have to watch for the next couple of quarters, keep very close watch on sectors like self-employed, LAP or housing and microfinance to genuinely claim that us or the industry is totally out of the woods.
Sure. There are expectations that the RBI may introduce some regulatory requirements for NBFCs above a certain threshold. Do you see any such move hitting the NBFC sector substantially?
So I don't know specifically what you are talking about, but definitely lots of regulations, lots of tough regulations on liquidity, on having a CRO, on capital adequacy. Many regulations have come over the last year or 1.5 years or so. And I can only say that in most of these, we maintain the highest level of governance, highest level of regulatory supervision. And we are, not only we, I believe that there will be about at least 10 NBFCs who are in that category. We try to be even better than what the regulations maintain in most of the cases. And we would believe that our governance will be proven actually with good regulations, with tough regulations. And, like any good company, we welcome tougher regulations and, would love to be in line with them, so that these kind of words like shadow banks, NBFC is a problem, all these words go away from the market. We will welcome tough regulations and be in line with them, better than them, so that all this murmurs and whispers go away from the market.
Sure. Expectations from the budget this time quite high, and substantial thrust on infra as well that's been anticipated. Do you see demand for infra credit spurt if indeed we do see that support coming in from the budget?
We would hope that lots of money goes into direct spending in infrastructure, which helps investments, which will ultimately generate employment and hence help demand. I think government has spent a lot of money on direct transfer to people to push demand. I think employment generation will also now should be the next step. So infra spending, it will be great if infra spending and direct infra spending by the government goes up. We would also expect in rural sector money and allocation to rural sector, self-employment, small industries to go up. What we would, I don't want to talk about narrowly what us or NBFCs want, but good for the country now is to push, regenerate employment, regenerate self-employment should be the government's push, and that would go a long way, definitely.
All right, we'll leave it there. Thanks so much for joining us this morning and talking us through that. Let's take a very quick break. Back in a moment.